today's bank is Valley National Bancorp. They're based in New York. I think they have a lot of their operations in New Jersey as well. So the ticker is VLY for the common shares. They also have Series A and Series B preferred shares with VLYPP and VLYPO. So you can those are publicly traded as well on the NASDAQ. What's interesting to note about these two preferred shares is the first one, I believe, is fixed to floating, and then or both of them are. The Series A, I believe, becomes floating in 2025, and then the Series B is already floating. So it's I think the SOFR plus maybe 3.75%, 3.85%, something like that. So this Series B is actually yielding about 9.85% right now. So that's a really high yield. Series A, I think, is being paid at 6.75%. Once we kind of dig into that, we can confirm, but I think that's the case. But it becomes floating in 2025, so at that point it'll be yielding about the same as the Series B, somewhere between 9 and 10% maybe. Well, depending on how interest rates go in the future. Anyway, just things to think about. You don't necessarily just have to buy the common shares. You could buy the preferred shares. All right, let's look at where things stand. So, Valley National Bancorp. It has a market cap of about almost $3.4 billion. That's a pretty big bank. They have an earnings yield or a PE ratio of 7.82. That's really low. Dividend yield 6.675% or 6.66%. It's a pretty high dividend yield. So we can already tell that it's priced really cheap. Based on the earnings and the dividend, especially so for such a large bank. So once we dig in, we'll be able to find out why that is, perhaps. Looking at the statistics side, we can see price to book is about 0.52. That's really cheap price to book. So not only is it really cheap on the earnings, it's also cheap on the net book value. So that's really unusual, and it'll be interesting to see why. If that's worth a buy, or if the risks are too high. Why is it so priced so cheap relative to most banks? We can already see that the return on assets is pretty low, return on equity is pretty low. And so maybe the bank is just not very profitable for whatever reason. Let's dig in and find out. So coming down to the balance sheet. All right. So at first glance, I can see about $400 million of cash. That's not a whole lot. Based on the size of the balance sheet, it's about 1.5%. Most banks it's 4 to 6%. So low amount of cash. And then looking at the securities, about a little over $5 billion. That is about 8% of the balance sheet. So that's a really low amount as well. Most of the time we'll see 11 to 15% of the balance sheet is securities. These guys only have 8%. So the cash amount coupled with the securities amount, I can already tell that the bank is not as liquid as what most banks might be. And the majority of their balance sheet is loans. About 82% of the assets is loans, and so that's really high. Most banks would be somewhere between 68 and 74%. So these guys being 82%, they're really highly allocated towards loans compared to what most banks might be. Also seem to have a lot of goodwill. About 3% of their assets are goodwill. Most banks somewhere between 1 and yeah, right around 1 or 1.5%. So goodwill can kind of be a dead asset if it's not necessarily yielding anything. So just looking at the way the assets are allocated, I can already tell that the bank's maybe not as liquid as what most banks are, but it being more allocated to the loans might give it a higher yield on its net assets. But we'll be able to see a little bit more about that once we get into the footnotes and everything. So looking at the liability side, we can see there's about 11 billion of non-interest bearing deposits, and that's about 20% of the liabilities. It's pretty much in the range of what a normal bank might be, so that's good. Yeah, and same thing for the earning deposits as well as the debts and stuff. Really right in the middle of the way that the liability structure of a bank might be. So we would expect probably the interest expense to be about a normal interest expense. Overall leverage for the balance sheet is about 9 times, so assets 61 billion divided by the equity is about 9 times. That's a little bit less than what we might see for most banks, but pretty close to the normal range. So the only unique thing about the bank then I would think is the higher allocation to loans, which might give them a higher interest income yield, but that is sacrificing liquidity. But they've got about a normal allocation to the different components on the liability side of the balance sheet, so interest expense might be about the same. So, based on those things, we could probably expect that net interest margin might be, probably about average, if not to the higher end of the range. Of course, we've also got to consider that they've got the preferred shares, which come out of the common shareholders' income, which is not a whole lot there in the grand scheme of things. So it's maybe not that big of a cut into the income. Anyway, so that was just a lot of guesses for how the income statement might look. So let's dive into the income statement. We can see in total they've got 828 million of interest income. The majority of it coming from loans, as we might expect, because most of the balance sheet is loans, and then a little bit coming from securities. So we'll see how this represents as percentage of assets. So as a whole, the interest income is about 6% of assets, and that's a lot more than the average bank. Average bank's somewhere between 4.75, 5.25, something like that right now. So these guys are earning a whole lot more interest income as a percentage of assets than most banks, and I think that's because what we were talking about, that they have just such a higher allocation to loans, which yield more than securities and more than cash. So that makes sense. And then, coming down to the expense side, we expected probably about a normal expense percentage, because a percentage of assets, because about an average leverage, average allocation to the various funding sources. And so what we find is 435 million, and that's about 3.32%. That's a whole lot higher than what we might expect, or what would be most banks. So most banks would be 1.5 to 2% of their liabilities as a percent, or the interest expense as a percentage of assets. But these guys have got about almost 3.5%. So that's really high, and it'd be interesting to understand why that is, because they have a normal amount of non-interest bearing deposits, and normal amount of borrowings, and interest bearing deposits. So perhaps their deposits are earning or yielding a lot higher percentage than what the average bank is. And so we'll be able to see that once we kind of get down into the MD and the A, but as it is, they're earning a lot more on interest income, but having to pay a whole lot more in interest expense as well, which makes their net interest income be almost 400 million, which represents about 2.58%. So that's lower than most banks. And so, most banks, we would like to see it, somewhere between 2.8 and 3.2, something like that. So this being 2.58% is pretty low, and it looks like it's because they're having to pay a little bit more interest expense than what we might see for most banks, and that's kind of cutting into the net interest margin. And also kind of looking at the provision as well, it looks like 45 million. That's about 0.36% of loans. So that's a pretty high percentage. Most time I would see somewhere between 0.10, 0.2%. So, either recently the credit quality of their loans has deteriorated, and they've had to record a higher provision than normal, because we can see, last year it was about 9 million. This quarter it's about 45 million. So, either credit quality is deteriorated, or they just have not been conservative enough in the reserve in prior periods. So, we'll get to look at the credit quality later once we kind of dig into the footnotes as well. But as we can see, the net interest income is lower, and that's also hurt by higher than normal provision. So, the after provision net interest income is a lot lower than what most banks is. So, but coming down into the non-interest income and non-interest expense, we can see the non-interest income is about 61 million, and that's only about 7% of the revenue. So that's lower than what we might see for most banks. Usually we'll see somewhere between 10 and 13%, but this 7%, non-interest income is about half of what we would see for most banks. And since the larger bank usually kind of has some additional sources of non-interest income than what the smaller banks do. So they've got the wealth management, insurance, capital markets, and sales, securities, and that sort of thing. And even the gain on the sales of assets here, 3.7 million, is kind of a one-time thing. So even, including that, they still have a low amount of non-interest income. So, but coming down to the non-interest expense, it's about 280 million costs to kind of run the bank, and 280 million comes out to about 31%, which is actually really, really low. So most banks somewhere between 41 and 47% non-interest income, or non-interest expense. That's the percentage of the revenue, but these guys are down at 31%, so that's actually a lot less, especially since they've got, a lot more complicated non-interest income types of things. So it's interesting. So, they have a whole lot less non-interest expense, but a whole lot less non-interest income as well, and a whole lot less net interest income. So that gives them a net income of 96 million, which is a lot less than what a normal bank might be. And so, the interest expense liability side of the balance sheet is really kind of cutting into their profitability. And it would be nice for them to find ways to, other sources of non-interest income here, or at least, increase the activity from these sources. The insurance commissions seem a bit low as well, but the non-interest expense side didn't necessarily save them, by having a lower non-interest income. Anyway, so the net income of 96 million amounts to about 0.6% return on assets. So that's really, really low. Right now we would normally see about 0.9 to 1.10%, so somewhere around the 1% range, but these guys are at 0.6%. So really, really low profitability. And also, some of that goes to the preferred shareholders. not a whole lot, but definitely eats into it. So 92 million. But as a percentage of the stock price, or at least the market cap, um, that's about 10.95%. So it seems like the market price has come down to be in line with what the normal bank might have as a percentage of the profitability. So this bank has a whole lot less profitability than most banks, but it also has a lower stock price. So buying these earnings could make sense at a 10.95% earnings yield, which is at the higher end. We normally look for somewhere between 9 and 11.5% earnings yield, and so these guys are getting about 10.95, so it's kind of at the upper end of the range. So even though the bank is a little bit less profitable, paying the price that is being traded in the market right now might make sense. Anyway, so as far as the profitability goes, we see that it's not as profitable as most banks, but let's look through the footnotes and perhaps we can find out, a little more of why that is, but also, what are the risks that the profitability will, deteriorate going forward. So going down here, one of the first footnotes that they have is the fair value. And so we can kind of see the fair value of the net assets relative to what they're carried at on the balance sheet. So, held to maturity securities are the ones that have the difference, as well as the net loans. Everything else is generally carried at fair value on the balance sheet, aside from the liabilities. Time deposits will have a difference of fair value, as well as more of the long-term debt. Anyway, so if we look at the held to maturity securities, we've got a 3.2 billion fair value versus 3.7 billion. So that's about almost a $500 million difference there, and then from the loans, we've got 47.7 billion versus 49.5 billion. So that's almost a $2 billion difference there. So those things together puts us about a $2.3 billion difference from the asset side. So the assets are about $2.3 billion less in fair value than what they are carried on the balance sheet. And so if you remember, we saw that the price to book was 0.5, but that might have been because the fair value of the assets is just so far less than what they're carried on the balance sheet as. And so that price to book on Yahoo Finance is basically what's in their financial statements, so the book value. But anyway, so it's a little bit not misleading, but if you're looking at kind of the averages across all the banks, you would want to put them at apples to apples. And so some banks might have all these securities available for sale, which are on at fair value. So if you don't adjust for the classification of the securities, you're not comparing apples to apples. And coming down to the liability side, there's some small differences as well. It's usually not as pronounced because the the liability side reprices a whole lot sooner than the assets do. And so the differences in fair values here, if we were to look at the time deposits as well as some of the long-term debt, which I think is mostly FHLB advances. So if we were to compare those differences, it's about 200 or 170 million difference there. So all in all, adjusting the net asset values of these down to the fair values decreases our equity by about 34%. So that's a pretty big hit. But even after doing that, if we were to compare the fair value of the net assets fair value tangible, so excluding goodwill and intangibles and stuff like that, we get a price to book of about 1.43. So you'd be paying 1.43 times, at this market price, 1.43 times the net asset fair value amount, which is below the normal range. Our normal range is 1.6 to 2.5 for most banks, and so this bank being priced that low relative to the fair value of its net assets, it's really, really cheap compared to most banks. So not only is it fairly cheap from an earnings standpoint, it's also fairly cheap from a net assets standpoint as well. So perhaps a pretty good deal for the bank. But if we convert all of these net asset or the net assets to the fair values and compare it to the fair value of net assets, that gives us a capital amount of 4.5%. So the fair value of the equity of the bank is only about 4.5% of the assets. Most of the banks we would see somewhere between 4.8, 6.8%, something like that. So these guys are a little bit below that range. So from a capital standpoint, they may not have as robust a capital position, and we already saw before that the liquidity position might be an issue as well. So some things to think about from the capital risk standpoint. But as it is from the pricing, it seems fairly cheap pricing based on earnings, but also the fair value of the net assets. So, all right. So coming on down, we can see a little bit more about securities. This is just the available for sale securities. The held to maturity securities are a little bit farther down as well. Let's see. Right here, yeah. So they've separated them out, but what you'll notice if you kind of look at them from a standpoint of being together, most of their securities are mortgage-backed securities, so 783 here, and then if we go to the held to maturity, almost 2.9 billion. So most of them are mortgage-backed securities, which kind of have an implied guarantee from the U.S. government. So fairly small risk portfolio of securities, which is good, and it's fairly common for most banks to be structured in this way. And so we can see, from the ratings, they're all, in the A's. A few stragglers back here with non-rated, but not that large of an amount. So we can say that the credit rating of the securities is fairly good. Of course, from what we saw with the balance sheet, the majority of the assets are allocated to loans anyway, so there's not really a material component to the securities, or as material as the loans, but of course it is there. So if we were to look at the term structure of them, we can see this is just the held to maturity ones, but for the most part they mature really late. So, or at least the mortgage-backed securities are kept separately. But I think somewhere down in here it says there's so the weighted average is about 7.88 years. So that's kind of in the 5 to 10 bucket. The held to maturity ones have a 10.82 weighted average remaining life. So we can say that these securities have a pretty far out repricing or maturity dates, which is a little bit higher interest rate risk as they mature later. They're kind of trapped into these lower interest rates currently. But as we said, the securities are a lower percentage of the balance sheet, so maybe that's not that big of a concern. More of the concern would be the loan side of things. So anyway, so skipping down to the loans, it'd be interesting to see the credit risk of these because remember from the income statement we saw there's a higher percentage of provision than previous periods, but also compared to other banks. So I'm expecting perhaps there's a credit quality issue. But so looking at this, we've got 9 billion of commercial C&I, and then and then 31 billion of commercial real estate. So most of the loan portfolio is commercial, number one, but also mostly commercial real estate loan. Yeah, so about 56% of commercial real estate, and then adding in the construction, that gives you almost 65% of commercial real estate, and then adding in some of the commercial loans, it's 18%. So really highly allocated to commercial real estate, which in our database, most of the banks somewhere between 33 and 42% commercial real estate. So these guys being at 56%, is a really high percentage relative to most banks, and that could possibly be why we're having to record some higher provisions than what we might normally see. But we can see a little bit more of that down here in the credit risk. So we've got the non-accruals plus the past dues come to about 362 million, and that's 0.72%. That's pretty much in the middle of a range for most banks. So really not that bad. It's about average. The non-accruals are a little bit high, 287. That's about 0.58% of loans. So that's a little bit outside the range to the higher end, but when you combine it to the accruing past dues, which would be kind of the non-performing loans, it's not that bad. So non-performing being non-accruals plus the 90 days and accruing. So it's about 0.6% of non-performing, and that's within the normal range of somewhere between 0.4 and 0.6%. So just from looking at that, the credit quality of the loans on the balance sheet isn't too bad. Coming down to look at the classification. So we usually like to look at the classified loans, so substandard and worse. And we can see there's actually a lot of those, commercial real estate, 910 million. C&I is almost a little over 200 million, it looks like. And this is just the commercial side of things. So the consumer side of things is down here, which we usually consider the substandard ones to be if they're 90 days or more past due. So a little bit of those as well. So if we were to add up all of the class, it gets us about $1.2 billion, and that's a lot. It's mostly due to the commercial real estate here of this, and then a little bit of the C&I. So the $1.2 billion as a percentage of the loans is about 2.39%, and that's a really high percentage of classified loans. So that might tell us a little bit about why the provision is higher than what we might normally see. And so then the next step would be, do they have a high enough reserve to allow for that large amount of losses? And so coming down to where they talk a little bit about the allowance, we can see they have about a $469 million allowance recorded. So $469 million compared to the $1.2 billion of classified loans is not very high at all. We're usually looking for the allowance to be at least 1-to-1 with the classified loans, and that's not the case here. It's about, what was that, 30 something percent or 0.3? Yeah, 39% of the classified loans have been allowed for. Most banks, it's usually around 100% of the classified loans have been allowed for. So these guys, the credit quality, it looks like, is in a pretty bad shape. It's not necessarily like like the loans have become non-paying yet, but there are definitely some cracks in them, and it seems to me that they might not be accruing enough of a reserve to combat some of those losses that might come down the pipe. So as far as the credit quality goes, I feel a little bit cautious with the credit quality. So coming down past some of this stuff, you can see from the borrowing perspective, they've mostly got FHLB borrowing and a little bit of subordinated debt. So the subordinated debt, it's most all of it reprices, I believe, in June 2025. So they're basically at a fixed rate currently, and then it's going to reprice to a floating rate in 2025. So just kind of pay attention to that. But as far as FHLB advances go, there's some that mature within a year. It's 100 million, and then most of the rest of it 1 to 5, and then some of it thereafter. So as far as the repricing of the FHLB advances go, most of them are in the 1 to 5 bucket, so that's not too big of a risk from an interest rate risk standpoint. But as far as the derivatives go, they have about 800 million notional amount, which they noted somewhere. Yeah, so 800 million here of fair value hedges. And some of those are hedging the fair value of loans, and some of it are hedging the fair value of FHLB advances. So I usually prefer the fair value hedges to be on the assets because that would mean that they're hedging the fixed rate assets and converting them into a variable rate, so that makes it the repricing risk less. And they don't really split out, which how much of the notional amount goes to assets or liabilities, but they do show the fair value of the asset, or the carrying amount of the assets that they're hedging, assets and liabilities. So about 500 million of it is to the loans, and about 275 million of it is to borrowings. So they did hedge most of it towards the loans, which makes me feel a little better about the interest rate risk, because it's making the assets at a variable rate, which will make the company more money as interest rates increase. So that's good, and can come down. I know we're skipping over a few things that are not necessarily as important to us. Now we're down into the MD&A. I was curious to know what the deposits were yielding, because the interest expense was a little bit higher than what I would have expected based on the allocation to the various components. But before we get into that, they've kind of reported some of the high-level statistics that we noted. So 0.63% return on average assets, that's really low. Return on equity, that's a really low amount, 5.91%. That's really, really low. So beating a dead horse here, the bank doesn't make as much money as most banks do. And they try to justify it from adjusting some of the metrics to pull out some of the expenses that might not be recurring. To show you, I think it was in a different place. Here we go. Yeah. So they're adding back some of the FDIC special assessment, which because of the failure of a couple banks early 2023, the FDIC did a special assessment for the larger banks based on I think it's based on the amount of uninsured deposits that they have on their balance sheet, but it only applies to the larger banks that I think have more than $3 billion of assets or something like that, which is most of the banks in our population. So, I kind of looked at this and I was like, well, most all the banks in our population had to pay this special assessment. So, pulling it out and comparing it to all the other banks, I think would not be appropriate. Also, the amortization of the tax credit investments, I guess you could, justify that, but they're making money on the income side, so I feel like if they're gonna, on the income side of the tax credit investments, so I feel like if they're gonna pull out the expenses, they would need to also pull out the income. Otherwise, they're kind of it's not really fair. Fair is not the word, but you get it. Anyway, so it doesn't really change the profitability that much either. It maybe gives them another 13, 14 million, but that's really not going to move our needle that much of how much profit that they have. So, they also sold a large, basically their premium financing division, and made a small gain, which they're pulling out. But in the future, the bank is not going to have the income from that division, so that's going to hurt them as well. So either way, all these adjustments don't really affect our decision that our opinion that the bank just isn't profitable, or as profitable as what other banks might be. So coming down into the yields, we can see that most of the high amount of 5.86% we were talking about is really high yield for assets, and part of it is because they've allocated such a large amount of their balance sheet to loans as compared to securities, and even their loans that they have allocated to are earning about 6.14%. That's a lot higher than most banks as well, and so it might be due to them being a little more allocated toward commercial real estate, which, as we've seen, is has a cost from a credit quality standpoint as well. So most banks right now might be somewhere around 5 to 5.5% for the loans, but these guys are 6.14%. So not only are they more allocated to the loans, which yield higher than securities, but they also are earning more on their loans than most banks. So that's awesome. But then coming down to the liability side, this is where it's really hurting them. It's great that they had an average amount of non-interest-bearing deposits on the balance sheet, so they're not having to pay interest for those, and so that's great. But it looks like the time deposits and interest-bearing deposits that they have are earning really, really high yields. 3.75%, 4.8%. That's really, really high. Most banks we have is somewhere between 2 and 3.5%, something like that. So these guys are having to pay a lot more on their interest-bearing deposits, which is hurting them. And then the FHLB advances are expensive as well as are the subordinated debt, which I think comes with a yield of 6.75, something, or maybe that was the preferred shares. But in 2025, these will be converted as well to the floating rate, which would end up being a whole lot higher, if interest rates either stay the same or increase by then. So all that together is giving them a net interest margin of 2.79%. That's really, really low. Most of the banks that we see will be about 3 to 3.5% for net interest margin. So So really, the liability side of the balance sheet is they've got some expensive funding sources here, which is making them a lot less profitable from a interest rate margin perspective. And as we saw previously, non-interest income is pretty low, but non-interest expense is a little bit low as well. So, but not low enough to help them to increase their profitability to what an average bank might be. So, coming down to interest rate risk, now that we're down into the interest rate risk section, we can see that the bank is, at least over the next year, is pretty asset sensitive. So as interest rates go up, the bank will make more money. So that's really great. I prefer my banks to be more asset sensitive over the short term. So that's exactly what I'm looking for. As we mentioned, or we talked about earlier, the securities mature a little bit later than what we would like. In some cases over 10 years. So they're trapped into lower interest rates for more than a decade, and that's not good from a interest risk perspective. But as we talked about, also the loans have a higher allocation on the balance sheet, so they're more important to us, and the loans seem to reprice pretty average. So about 33% of the loans reprice within the next year, about 66% reprice within the next 5 years. So that's pretty much in the middle for the average of what most banks are. So also what's helping them is on the liability side is not only do they have kind of a good amount of non-interest bearing deposits, which would have no interest rate risk at all. I guess the risk would be that they could migrate to interest bearing accounts, but as they are now, no interest rate risk there. And then plus, as we saw, the FHLB advances most of them are 1 to 5 year maturities and repricing. So really, when you're comparing the assets to the liabilities, as is evident here, the assets seem to reprice a lot faster than the liabilities do, and so that reduces our interest rate risk if interest rates were to increase. So then, looking at the liquidity side of things, as we talked about earlier, it looks like they didn't have as much cash as what most banks might have, or as much securities as most banks have. So those are the two liquid assets that most banks have on their balance sheet. So we can say that the bank is maybe not as liquid as the normal bank, and you can see their loans to deposits is about 102%. And that's a lot higher than most banks. Most banks somewhere between 85 and 90%, something like that. So they're really highly leveraged in their loans. And so if you were to add up the cash, which is these two here, about 400 million plus 542, and then the unencumbered securities, so it comes out to about 1.2 billion. So our calculation is a little bit different than ours because we're taking out securities that they've already pledged. But 1.2 billion as a percentage of deposits is only about 2.5%. So they basically have 2.5% of their deposits in liquid assets, and that's really low. It's really scary low, actually. Most banks is somewhere between 13 and 17% of on balance sheet liquidity, but these guys have 2.5%. So really low liquidity. And also, as we saw earlier with the fair value adjustments, by adjusting everything to fair value, they also have a low capital position as well. So not only are they a little bit less liquid than most banks, but they have less capital available as well. So that's really risky given the quality of the loans on their balance sheet currently, especially. and such a high allocation to loans. So I would say that the liquidity capital position of the bank is not as favorable as what we might like to see as well. So that's a major risk. So I wanted to come down. Oh yeah, so here's the regulatory ratios as well. So we can see that leverage ratio 8.2%, almost 10% for Tier 1, common equity Tier 1 9.3. So these ratios are really, really low as well. Part of it is the high allocation to commercial real estate. Commercial real estate gets a pretty high percentage of risk in the risk-based capital. But so if we were to compare these to the average bank, these would be really, really low. They're not, outside of the capital adequacy requirements, but they're actually kind of close. So that corroborates a little bit of what we were talking about, how the capital, we've got a little bit higher capital risk than what we might like to see, and liquidity risk could exacerbate that as well. So one cool thing is they got almost 25 million shares that's been authorized to be repurchased. That's almost 5% of the amount of shares outstanding. So that reduces the amount of shares, which would increase the earnings per share. So something to think about. But I feel like their precarious liquidity and capital position might suggest to them that they might push this out a little further until they can straighten things up. I don't think that they're in a position to where they would go bankrupt or anything like that. I mean, they have the ability to borrow from the FHLB as well as the Federal Reserve, and they've got the ability to borrow up to it's like $24 billion, I think. Let me go back to that place, but that's what I wrote down, was 24 billion. So that ends up making it to where if they needed to borrow some money from wholesale borrowers, yeah. So FHLB, Federal Reserve discount window, line of credit from other banks, unencumbered securities, yeah. So they've got probably about what does it say? They have 87% of off-balance sheet liquidity compared to deposits. So if you were to add up the off-balance sheet liquidity plus liquidity they have on the balance sheet, it's about 87%, which is higher than most banks. But of course, if they were to borrow additional amounts from these sources, they would be paying more interest expense, and it would cut into their net interest margin even further. So I feel like they would eventually need to start borrowing some more, especially if they're going to be repurchasing shares, or if interest rates start to increase. As we talked about in 2025, a lot of their debt and preferred shares are going to convert into a floating rate, and so interest rates will be higher at that point. So there's a lot of risk at that from that standpoint. So to recap, I think that the profitability of the bank is a lot lower than most banks. Most banks are earning a little bit more money than they do, and from the risk side, have a little bit higher risk from credit quality. So the loans could get in a pretty dicey spot soon, and I don't think that they have a high enough reserve to combat those losses. From a capital standpoint, they don't have as much liquidity. As we saw, they don't have a whole lot of cash and don't have a whole lot of securities. But they do have quite a few loans that come due soon, so that'll help some with the cash flow. But I do think that the liquidity capital position of the bank is not as robust as what the average make might be. From an interest rate risk perspective, they're good. A lot of the assets reprice sooner than the liabilities do, so if interest rates were to go up, they won't necessarily get squeezed that bad, and might actually make a little bit higher income. So the profitability versus the risks. So now if we consider the price, as we saw, the price on the earnings and the price on the assets seems really, really cheap. But you're basically getting compensated for those risks, I think. From the credit quality risk and also from the capital risk. And I feel like the cheaper pricing isn't cheap enough for those risks. You could probably make the case that that the earnings yield of what was around 11% or so could be enough to compensate for the capital risk and the credit quality risk. But I feel like I would want a higher yielding. I would want my earnings to be yielding a little higher to compensate me for that risk that I'm taking on those sides. So that's the gist of it. Let me know in the comments if there's anything I missed, or if you have a different opinion of where things stand. I'd love to hear other people's thoughts. So just let me know. Thank you for listening.